Hello, Alex back again. This is Accounting 202. So the second part, this is continuing off. This is not 201, this is 202, the second half. Chapter 12, Explanation, Accounting for Partnerships and Limited Liability Companies. So I'm going to read the intro, one of my favorite parts of this book. It's a Razor USA Limited Liability Company. So most good ideas begin as a solution to a problem, such as Gino Sai. Gino's legs got tired as he walked around his Taiwanese bicycle factory. As a result, Gino spent 5 years designing what is now known as the Razor scooter. Little did he know that this new lightweight, foldable scooter would be used by people of all ages, as well as being an extreme sport for the youth. That's what's interesting is it's a sport now. You can see Razor scooters at any of those skate parks. You can do just as many tricks on those as any other thing. Today, the Razor scooter, along with other Razor products, are sold worldwide by Razor USA. The letters LLC stand for Limited Liability Company. Unlike sole proprietorships, illustrated in the prior chapters, an LLC business is a form that normally has multiple people owning it. So, the entity form chosen by the business has an important impact on the owner's legal liability, taxation, and ability to raise money. The four major forms of business entities discussed in this text are proprietorship, partnership, limited liability company, and corporation. Proprietorships have been discussed in prior chapters. Partnerships and limited liability companies will be discussed in this chapter, and corporations will be introduced in the next chapter. So basically there's four types of businesses, of ways to organize a business. Proprietorships, simple to form, one owner, tons of legal liability. So if they sue you, not only can they sue for what the company has, they can also go after your personal assets because you have no legal protection. They're not taxable. So the company itself is not taxable, but the income that the owners make is taxable. Limited life. When the owner dies, the business goes away. And then a limited way to make money, or a limited way to gain capital. So it's hard to gain, you can't issue stocks, so that's what that means. Partnerships is usually two or more people. It's just like a proprietorship, so there's going to be lots of legal liability, but it's not taxable, limited life, and it's only kind of complex to form, not too bad. Limited liability companies are a legal entity that is a lot like a partnership or a proprietorship, except that there is no legal liability for very limited legal liability for the owners. So basically, they when they sue you, they can only get what the company has. They can't get personal assets. Not taxable, unlimited life. So even when an owner dies, the company still carries on. And there's more ways to earn capital. There's a little bit easier ways to earn capital, more so than a proprietorship or a partnership. And then those are the three. There's also corporations and S-corps. Corporations are taxable. They get the double tax, but I guess we'll go into that a different time once we get into the corporation chapter. So of course, when you form a partnership, everyone contributes assets, so cash, accounts receivables, inventory, store equipment, and then you get equity based on how much you contribute. What's the value? Also, owners can also bring to the company also debt. So any debt you take with you to the company, so you get payables. And you can also take any allowances for doubtful accounts with you as well that you don't think the company will collect on. And basically, you debit the assets for what you brought, and then you'll credit your any liabilities, any accounts payable, and then any allowance for doubtful accounts, and then you'll get anything left over as capital for the owner. Income is divided. See, that's what when you have partners, income's divided in multiple ways, and I'm gonna have to go over a problem to show you. I'll have to do like a problem, how to divide up income, because it can be tricky. So different ways you can do monthly salaries. So like here, Jennifer gets 5,000, Crystal gets 4,000, and then the rest is divided equally. So if they make more than 9,000 in a month, it's equal. But that's how much they get right off the bat. 5,000, 4,000. You could do by a percentage of their capital account. So 12%, like let's say 10%, and Jennifer has 100,000, she get 10,000. And let's say Crystal only had 1,000, she'd only get 100. And then you divide the remainder equally. So there's different ways to disperse income. Either salaries, either percentages of the initial investment, which is their capital account, percentage of their capital, and equally. Also, losses are also divided in the same way. So if income's divided equally, losses are also divided equally. When people come into the business, so like admitting a partner, the partner can either buy in, so they can either buy a portion of the interest. So let's say, Jennifer and Crystal, let's say Jennifer sells 10,000 of her interest or her equity to Sam. Sam pays 20,000 for only 10,000. He only gets 10,000, but there's no entry on the books because, wait, there is. Jennifer's giving up 10,000 of her equity. Sam's getting 10,000. So you're going to debit Jennifer's equity for 10,000. You're going to credit Sam's equity for 10,000. People say, where's the 20,000 go? That's off the books because Sam paid 20,000 to Jennifer for 10% of her interest in the company. That doesn't have nothing to do with the company itself. He paid personal finances to her off the books for that interest. And then another way people can come into the company is Sam could also bring assets to. So Sam could say, okay, I'm going to contribute 10,000 cash, 5,000 in accounts receivable, and 5,000 in office supplies. And so he'll get 20,000 equity because of what he brought. So there's different ways you can actually get into the company. It's very interesting. You'll see this in CPAs. CPAs do this. Firms, law firms, probably doctors, like practices. I mean, any of those kind of like professional service jobs. We have to have like high education. So yeah, contribute assets. Sometimes before a partner's admitted, they'll reevaluate what everything's worth. So sometimes you might have a loss or a gain. If merchandise inventory went up, like they're checking the books and they're saying, hey, this stuff's worth 3,000 more, then everyone will gain a percentage in equity of that 3,000. So like if there's Jennifer and Crystal, we each get a 1,500 increase to their equity, and then their merchandise inventory will be debited for the 3,000. So very, very interesting. This is really, I mean, most businesses, 90%, I think, no, 80% of the businesses in America are sole proprietor or partnerships. They're not corporations, they're not limited liability. So most of them are like this. Here's bonuses. Bonuses are, let's say the new partner comes in and his skills aren't the greatest, but he really wants in. And so the partners will probably say, okay, we'll give you 20,000 equity, but you have to pay 30,000 to get in. So basically, he's paying $20,000 for the equity and then $5,000 to each partner as a bonus. And it can be the other way around. If the partner is really skilled, really a hard worker, and they really need him, and it's the opposite, then let's say they'll give him $30,000 equity, and he'll only pay $20,000. What happens is they gave up $5,000 in equity to him, so they're paying him a bonus to join in. It's a very interesting way to do it, because you can either pay them a bonus or you can get the bonus. And I think that's a problem. Maybe I can, if the problems are small enough, maybe I could do a couple. When a partner dies, basically they close out his account after income and then write him off the books. When the business is liquidating, they sell everything off first. If they have a gain, here's the steps of liquidating. Step 1, sell all your assets, get cash. If you have a gain, if you sold the assets for more than they're worth, you got a gain. You gotta divide the gain up among people by the income sharing ratio. If it's a loss, you divide the loss up by the income sharing ratio. Then you pay off all your liabilities for the company, and then whatever's left over after liabilities, the partners get as cash, whatever their capital balances are after that. So whatever your equity is at the end of the company's life, is that what your cash is going to be. And we'll go over that. There's problems for that too, losses and gains. Basically, and then they still use partnerships. The statement of owner's equity would be a statement of partnership equity, very similar. It would just have people divided up. Like the statement here, it has like Jennifer would be here, Crystal would be here, and it would show, what their balances are, and then a total right here. Then there's financial analysis, like revenue per employee. You could do revenue divided by number of employees, which would give you revenue per employee. Good thing to know. Here they have a example for Starbucks. They had $10,383,000,000 in revenue, I guess, for a year. And divided by 172,000 employees would equal $60,366 per employee. So $60,366 per employee. That's crazy. McDonald's is even bigger. 23,500,000,000 divided by 400,000 employees, $58,750 per employee. So this was Chapter 12, Partnerships, Limited Liability Companies. Please subscribe and like. Comment if you have any questions or whatnot. And I'll do a problem next, and it'll probably clear up stuff a little better, because sometimes it can be kind of confusing. Maybe I'll do a liquidation, and if I have enough room, maybe I can fit 2 problems on it. But yeah, partnerships are basically everybody shares income and shares losses. That's the biggest thing. And you can either contribute assets or just buy into it. So, but thank you, and I'll see you for the next video. I hope you enjoyed the scenery.